Most traders buy shares to go long a stock, but there's a strategy out there to triple your returns while using only 1/3 of the capital and risk. I've made over 6 figures from this strategy since 2018. In this lesson, you'll learn this powerful strategy and will save thousands immediately. The strategy that we're going to be learning today is called the deep in the money call. What is it? Deep in the money calls are a powerful, capital efficient option strategy designed for bullish traders who want significant market exposure but without the full cost or full risk of owning the shares outright. It composes of buying calls that are 1 to 2 years out in time, so this will give your trade time to develop while minimizing the pressure of short-term price swings. The delta that we're going to be using is approximately 90 delta. With 90 delta, the option will move nearly dollar for dollar with the underlying stock. So it will behave like owning the shares, but at a fraction of the cost. It won't be moving 1-to-1, but at 90 delta, it will be moving 90 cents per every dollar move on the stock. The deep in the money call is also a very low extrinsic value option. Minimal time premium means low theta decay. Your position will only erode slowly, so it will protect your capital over time. Let's talk about the benefits of a deep in the money call. The deep in the money call strategy delivers a compelling combination of reduced capital requirement, capped downside, and an amplified upside, all without using margin or borrowing risk. The first benefit is it will cost 3 times less capital to use this strategy versus buying the stock. Control 100 shares for roughly 1/3 of the cost of buying the stock outright. You will have 3 times less risk because the maximum loss is limited to the premiums paid and there's no margin calls. And last but not least, this is the best part of it, it will times 3 or more your potential return. The same dollar gains as shares applied to a much smaller capital base, which dramatically increases the ROI. Deep in the money calls are risk defined, so they don't require any margin and can be used inside tax advantaged accounts like Roth IRAs or TFSA or any retirement accounts in your respective countries. Let me go over how you can buy this deep in the money call. I have SPY open right here. The first step you want to do is open the option chain. The second thing you need to do is look for the expiration that is 1 to 2 years out. I personally like to buy the 1.5 years out options. The 513-day option looks good to me. I open it up. We're going to look for the call side, which is always on the left. And we're going to look for the 90 delta calls. Right here, this column is the delta column. And we're going to look for 0.9. We're going to go very deep in the money. So it means it's going to be very far away from at the money, the current stock price. 90 delta, I can see the 90 delta is the 440 strike. The current price of SPY is $750. So this is very deep in the money, 90 delta. You just click buy on it, make sure it's B and it's green and you're buying it. Try to get the mid price. What I usually do is I go below the mid price. Right now the bid ask spread is not that good because it is after hours. So if you guys try this during the daytime, it should be a bit nicer. But one trick is to use a theoretical price, and that should be similar to your mid price. Now, if the theoretical's option price is lower than your mid price, start there first. So I'll try to buy this option for $334. Try that. That's how you buy the 90 delta deep in the money options. It's that simple. By the way, traders, if you guys like what you're learning so far and want to learn more, check out the link in the description below to download your options for income playbook and join my newsletter. Let's talk about when to use deep in the money calls. You need to have the right market outlook. First of all, deep in the money calls are a purely bullish strategy. They are best deployed when you have a strong directional conviction that a stock or an ETF will move meaningfully higher over the coming months. Ideal candidates will include blue chip stocks, sector ETFs, and large cap names with liquid option markets and strong technical setups. It is very important for us to use the strategy on very liquid options so that we don't get bad bid-ask spreads. I will show you in a little bit how to look for liquid stocks. The holding period. This is a swing trading strategy. This is not day trading. Deep in the money calls are designed to be held for months, riding sustained trends rather than short-term volatility. So some entry triggers, for example, could be stock bouncing off key supports, breakout from consolidations, sector rotation into a bullish theme, or strong earning catalysts ahead. Let me go over how you can look for liquid stocks. In Tasty Trade, under your watch list, click on the gear icon and look for the liquidity rating button. This will show you how liquid a stock is. We only want to be trading options with 4 out of 4 stars or a minimal 3 out of 4 stars. For example, XLE right here, you can see the liquidity rating is 4 out of 4 stars. That's a great candidate. QQQ also 4 out of 4 star, excellent. XLP is not bad, 3 out of 4 stars is acceptable. Anything under 2 stars or below is not acceptable. For example, EWW is not acceptable to trade. If I show you the option chain, you'll see how horrendous the bid-ask spread is. If we go up to 90 delta, there's almost a 5-point spread on a $20 option. That's almost 25%. So that's unacceptable. You will get killed and you will get slaughtered by the bid-ask spread. You'll lose a lot of money on that alone. So avoid that. As for stocks, you always want to look for large cap stocks, names that are in the SP 500 or QQQ. And even then, you still need to look at the liquidity rating. Nike, 4 out of 4 stars. Nike is a good example. Oracle is also another good example. On top of that, we also need to look for the options that has high option interest. For example, if we look at this option chain, then 88 delta only has 4 option open interests. That is not good. Let me give you a good example of what we should be looking for. If you look at this Apple option, the 91 delta has 1,000 open interests, so that's great. The 91 delta, there's 2 choices, 160 or 165. Which one would you choose? The answer is you should choose 160 because there is more open interest. There's 1,000 versus only 400 interest. And the delta is similar enough. Always go for the higher option interest options for a better fill and more liquidity. Managing the deep in the money call. Active management is key to preserving the advantages of a deep in the money call. You will have 3 primary exit and management tools at your disposal. So after you open this deep in the money call, if you're still in the trade at 90 days to expiry, you need to manage it because theta decay accelerates sharply within the 90 days to expiration. If you remain bullish, roll the position forward in time, close to the near-term call, and open a new 1 to 2 year out option to reset your time advantage and to avoid theta decay erosion. If your option price has gone up a lot, you can choose to exercise your option and to take ownership of 100 shares at the strike price. Note, I don't do this personally because exercising forfeits any remaining extrinsic value in the option. So this is generally less efficient than selling the option unless you intend to hold the shares long term. Last but not least, this is my favorite way to manage the deep in the money call, and it is to sell the call option to close this trade out. This is the cleanest and most capital efficient exit. Simply sell your call back into the markets to capture both intrinsic and any remaining extrinsic value. This will close the position entirely. This is the preferred way to manage this trade. Risk management. Even with a defined risk structure, disciplined risk management ensures a single losing trade never derails your whole portfolio. Two proven approaches. Technical analysis signals. Exit the trade when the price action invalidates your bullish thesis. Some triggers would be maybe it's breaking a key support level, breaking down from a rising trend line, bearish reversal pattern confirmation, moving average crossover to the downside. Let the chart tell you when you're wrong. Don't use your emotions. You will be needing to use a stop loss. It can be technical or it can be a dollar-based stop limit. You can define your maximum acceptable loss before entering the trade. A common rule of thumb is to limit the risk to 2% of your net lick value per position. So let me give you an example. On a 50,000 account, risk no more than 2%, which is $1,000 per deep in the money call. This keeps the losses manageable and your portfolio intact for the next opportunity. So if your account is 100,000, you should not be allowing your stop loss to exceed 2%, which is $2,000 per trade. Let's go over some calculations and math. Understanding your break-even and maximum risk before entering any deep in the money call is essential. Here is how the math works with a simple example. Your break-even is very straightforward. Add the premium to the strike price of your call option. So, example here, the stock price is $100. You pay a $10 premium to open this deep in the money call. So your break-even would be 100 plus 10. So the stock has to go past $110 for you to make money at expiration. You don't have to wait till expiration to profit. Just keep that in mind. Your maximum possible loss is simply the total premium, the debit, paid for the call, and nothing more. There's no margin usage. There's no risk of losing more than the debit paid. Full defined risk from day one. That's why it's allowed in tax advantaged accounts, because the risk is defined. This makes deep in the money calls one of the safest leverage strategy available. Your worst case scenario is always known before you enter the trade. Let's look at a P&L analysis case study. To illustrate the capital efficiency of a deep in the money call, let's look at this example with XLV. The current stock price is $150. So to buy 100 shares of XLV at $158, it will cost you $15,800 in capital. Your full portfolio exposure is tied up in a single position, and the downside is limited by the stock going to zero. So at most you're going to lose if this stock goes bankrupt, it would be only around $16,000. Now, if we were to buy a deep in the money call on XLV, will cost only about $4,100. That is less than 26% of the stock cost. You control almost the same 100 share exposure with a defined risk and capital freed up for other trades. It's not exactly 100 shares and 90 delta. Remember, it's around 90 shares, but you're using a quarter less amount of capital. So this is a very good deal. The deep in the money call frees up almost $12,000 in capital compared to buying shares. Capital that can be remain in cash or diversified or used for other trades. Let's talk about what happens when the stock moves against you. The deep in the money call dramatically limits your losses compared to owning the stock shares outright. No matter how far the stock falls, your loss is capped at the premium paid, the cost to buy the deep in the money call, which is $4,100. Let's look at this chart right here and let me explain how to read this table. So if at expiry, the stock does not move, the stock price remains at $158, then our P&L for the stock will be $0 because there's no movement. If the stock goes down 25%, we will hit 118.5. We're going to lose 25%. If the stock falls 50%, we're going to lose 50% of our capital, which is about $8,000. Let's go down the chart. If we lose 100%, if the stock goes to zero, then we're going to lose our full $15,800. Now, when we use deep in the money calls, notice there's going to be way less risk when the stock falls to zero. So it's a much safer strategy. Let me explain what happens. So at expiry, if the stock does not move at all, we're going to lose a little bit of money because we have to pay for the premium. The premium to own this deep in the money call for a year and a half costed us about $200. So if it doesn't move, we're going to lose that $200. Now, if the stock moves down 25%, we're going to lose the same amount as if we own the shares. Almost the same, just about $200 difference. And that is because of the premium that we paid. So if the stock goes down 25%, notice that we actually lose less than owning the stocks, 100 shares of the stock, because we only use 90 delta call options. So instead of losing a dollar for dollar, we're losing 90 cents on the dollar. Now, if the stock drops 50%, notice if we own the shares, we're going to lose around $8,000. But at that point, our call option only loses $4,100 at expiry. Why is that? Because the cost to buy the call option was only $4,100. We cannot lose more than that. It is capped at 100% loss. Now, if the stock goes to zero, all the way to zero, we are still only losing a max of $4,100. This is 4 times less than if we were to own the stocks outright. That's why this is a very wonderful strategy to minimize your risk. You're risking a lot less to get the same exposure of movement on the stock when it goes up. You're protecting your downside risk by 4 times less risk. Now let's talk about what happens when the stock goes up and look at some numbers. If the stock goes nowhere at expiration, then we make $0 if we own the stock shares. Very simple. Again, we'll lose a little bit of money with the deep in the money call because of the premium paid. Now, if we gain 25%, the calculation for 100 shares is very simple. We simply times 1.25 and we're going to make about $4,000. At 50% gain, we're going to make about $8,000. 75% gain, about $12,000. And at 100% gain, we'll double our money at almost $16,000. The gain is symmetrical. It's identical to the percentage move. Now, if the stock moves 25% in our favor, our deep in the money call will gain a little bit less than our stock shares. A little leg of about $500. Why? Because we only have 90 delta, and whenever the stock moves up $1, our option pricing will only increase by 90 cents, not exactly $1. So there's a little lag. But don't forget, we only invested $4,100 to buy the deep in the money call. So actually the return is $3,500 divided by $4,100, and the result is actually a staggering 84% return. It's highly leveraged. The return on investment is much higher. Now let's look at 50% gain. It's almost the same. With stocks, if we gain 50%, we'll make about $8,000. With the deep in the money call, we're going to make about $7,300. But the percentage gain wise is we're dividing that by 4,100. So the amount we gain is actually 177%. That's a huge difference. Let's talk about when we double our money. If the stock price doubles, we're simply just going to double our money with 100 shares. So we'll make about $16,000. With the deep in the money call, we're going to also make approximately a little bit less than $16,000. But if we divide that by the amount we paid to buy the deep in the money call, which is only 4,100, our return is actually amazingly 380%. That's almost 3.8 times the returns compared to buying the stock outright. Not to mention, we use a lot less capital, almost 4 times less capital. So 100% stock gain yields 100% return on $15,800 of stock. But it is a 380% return on $4,000 worth of deep in the money call premium. The same market move, but dramatically different ROI. So traders, I hope you enjoyed this lesson. I hope I opened your eyes to a new way of going long. This way is a way safer way to go long instead of buying shares of stock. Not only it's safer, it uses 3 to 4 times less capital than buying the stocks outright. And you can do this strategy in your tax advantaged accounts. This is one of the most powerful strategies out there in the whole option realm. Traders, trade small, trade safe.